All right, so let's talk about what's important. I want to kind of shift gears and go away from the portfolio. I know several of the people that are here tonight just wanted to kind of talk in general about what really does matter, especially to as you're just getting started on the journey, perhaps with an investment club or on your own. But we're going to go over just some of the real basics. Number one, invest regularly. And some people think that's about money, and I kind of maintain it's not. Yeah, the money's important. Get your regular contributions in there. But it actually goes beyond that, and this is true for myself, probably for some of the other guys in the room tonight. Discipline is tough, and you got to figure out how to do it. I do think the ladies, this is an area where the ladies do have an advantage over most men. They're able to make those monthly commitments and all that kind of stuff when it comes to the money and the study efforts and everything. But I do like to point out that much of the success of long-term investing does revolve around this notion of discipline, and for me, and I think this is, so many of you know this to be true, it's about so much more than the money. The time studying and supporting the efforts of your colleagues, and the friendships. Some of the friendships literally span across the globe and span across decades, and that's all part of it too. And Don Danko used to like to talk about how probably one of the best ways to think about what we do in these investment clubs that meet on a monthly basis is it's very much like a Weight Watchers model of accountability and regular meetings with discipline. And some of the tougher things in life can be made easier by leaning on colleagues. So again,
and
it's
chanting.
Discipline. And chanting can be good too. Or making embroidered tapestries with the cult sayings that they hang on the wall or fly on their masts. What else is important? Well, invest regularly. That's certainly a big one. The discipline matters. But my second one, and this is a little different than what some of you have seen, it has more to do with being prudent. This is actually a combination of what some of you would know as Rules 2 and Rules 4. But rule number 2, be prudent. And a lot of times it's a matter of coming together with friends, getting things like you see there in the cartoon, a second opinion. Be skeptical, challenge assumptions, be curious, be polite, but have debates, learn lessons of history. Diversification is one aspect of being prudent. Back a few minutes ago, and I was talking about how we did a wonderful job of brainwashing the masses on sector diversification. Ken and I talk about this all the time. If we had only done half as good a job brainwashing the masses on the importance of small, medium, and large companies in portfolios, that's the diversification you really ought to be brainwashed on, and we'll talk about that in a few minutes. So seek a balance of growth rates and sectors, but again, that's almost a secondary concern for me. Let your gains compound. Lori mentioned apparently a success story with Chipotle Mexican Grill. I suspect that those proceeds of sale have already been deployed into something else where they saw greater potential. And then one of the other things we'll talk about a little bit later is when you get enough experience, there's also this notion of maybe for it's been a while since people in our community or clubs within our community have really talked about this notion of preserving capital. It's something that we're studying very carefully at Manifest Investing right now. Again, we'll talk about that in greater detail in a few minutes. So again, invest regularly, be prudent, do the prudent things, and be diligent. And third, and this is the core of a lot of what we do, discover and own leadership companies. And by that we mean go out there and find the best of the best. Find the high quality companies and find them when they're on sale. One of my favorite authors or writers or speakers is Jeremy Grantham, and he defines quality as just simply dependability. And that dependability extends beyond sales, profit margins, could even be PE ratios, to simply decent or solid returns to shareholders. So again, the dependability of consistent, solid results is the way he would characterize quality. And I think Ken just mentioned chanting. Up, straight, and parallel is definitely very, very, very closely related to this notion of quality. And the other thing that we do is just to encourage people, and we'll be talking about our industry study snapshots here in a minute. Benjamin Graham, for those of you who don't know Ben was Warren Buffett's investment professor or teacher, so literally the mentor of Warren Buffett. So Ben Graham says that management is so important in companies. Growth stories, a lot of the management, we really do watch the growth characteristics, the profitability characteristics over time, but quality really does reside in how they compare versus others that are trying to do the same thing. Other companies that are trying to access the field of opportunity and win the competitive battles. And then last but not least, you take those three and roll them into that one major statement on the lower right there. And this is what was intended, by the founders, by the gurus over the years. That doesn't say buy and hold forever. It doesn't say buy and hold and forget. It didn't say refuse. It doesn't say refuse to sell. It says buy and hold for as long as it makes sense to do so. That could be anywhere from months, I suppose even weeks, to decades. I mean, I was in an investment club that had bought stocks that it still held that were purchased back in the 1960s. So almost back to the time I was born, and they still had those stocks in the portfolio because it made sense to do so. And again, if you get an opportunity to sell a stock when it makes sense to do so, you should access those opportunities willingly and knowingly. So let's talk about the returns a little bit. This is one of my favorite charts. Some of you have seen it before, maybe in a little bit different fashion. We are here for the returns. We try to forecast returns and keep track of what the actual returns are. This is one of the charts that we at Manifest refer to as a chronicle. From left to right, it's literally it's a check-in on a quarter-by-quarter basis going all the way back to December 1994. That's what you see over here. And it's as if you sat down and had done a stock study every quarter since 1994 up to the current. And you can see that the stock price is graphed here in the green bar, and it's had its ups and downs. It's actually been, relatively steady, but it's had its moments, its ups and its downs, its peaks and its valleys here. But if you'd actually taken a look at the results of a stock selection guide, and I'm not going to go too deep into it, but we really do believe that a great portion of the time, not all the time, but a big portion of the time, if you've done your stock study carefully enough, and you check the results of your stock study, your projected annual return in Section 5 of your stock selection guide, it should resemble the value line low total return forecast from the value line report. This red line is the value line low total return forecast over the years, quarter by quarter. And again, we like to point out, this is a buying opportunity. This is a selling opportunity down here. So selling opportunities down here, if you've managed to sell here, this is a serious selling opportunity, because notice that, if you had sold at this price, you would have had literally years until it went back into the buy zone somewhere around here. And then the price actually did dip way down to where it became quite an awesome buying opportunity, and it's actually settled back into this range. Take a look at how often it's between 13 and, let's say, drop down here to 3 or so. So between 3 and 13, virtually every point, every quarter for the last 15 years, with the exception of these 3 up here and a couple of these down here, are between 3 and 13%. So again, McDonald's historically has been a company that has lived between 3 and 13%, according to the value line low total return, with this very notable excursion here and this excursion down here. So again,
Mark, we have a question from Don. Don wants to know, do we have access to this chronicle like the Eagle, and where we can put in the data ourselves?
We actually don't, although we're working on that next. When we get the website out and running, we do have the chronicles available for many of the Manifest 40 companies, the 40 most widely followed companies out there. We probably will provide that capability for people to at least track it going forward in the future, but it doesn't exist right now, at least not exactly. But the chronicles are on the website, or in the forum, for a number of companies. Anyhow, that's important stuff. Okay, let's talk about how many stocks are enough. The Northern Traders currently have 5. Well, what type of numbers should they be thinking about aiming for? The answer to this one is it depends. It depends on the people in the club. It depends on how they want to approach the portfolio management, design and management challenge. But from the standpoint of mathematical diversification, and again, we actually don't believe in this definition of risk. That's the Wall Street definition of risk. We don't think that that's what risk really is, but it is a measure of the ups and downs, the volatility of prices. And all this is basically saying is that you can smooth out some of that up and down volatility by having at least, we say roughly 12 stocks is where it starts to flatten out here, and anywhere in this range, and then at some point you're no longer taking out risk by adding additional stocks. So that's where this answer comes from. For the average investment club, for the average individual investor, 12 to 20 stocks is enough. I mean, most professional investors would consider that pretty concentrated, but we think that that's enough diversification if you study the stocks and stay abreast of developments. Stay in touch with them. Don't just put them on autopilot. 12 to 20 is enough, and you can see that. Again, for those of you that just want to wrap a visual around the concept, you don't want all your eggs in one basket. So again, the answer is 12 to 20 or so. Lori, does the club happen to have a target for where you're trying to head with that?
Well, I think, there's also the trade-off of having enough time and energy to watch all of them and the money to buy more. Mm-hmm. So we actually haven't gotten to where we think we're close to having too many. So we haven't talked about it a lot. I guess the idea is to stay kind of fairly evenly spread out amongst what we do have.
Mm-hmm. But you certainly wouldn't want to slow down adding stocks until you got 12 or so. And
no, oh no, it's the only thing slowing us down. We don't put a lot of money in every month, so mm-hmm. It's just kind of self-limiting at the moment.
Well, the foundation is there, and you can only build the house so quickly. So.
Yeah.
But that would be the situation for again, our recommendation to the average investment club out there, somewhere in that range. George Nicholson used to talk about, part of the correct response to that question is, well, how many can you handle? If you're in a club that really has active people following stocks, the number could actually be a little higher than that. Tom O'Hara used to like to collect these real small lots of small companies so that we could watch them more closely because we own just a few shares of them. So our portfolio might have had 30 to 40 stocks in it at one time. Many of those 1% type positions on those smaller companies. So that can make sense depending on, again, on the personality and the kind of the psychology of just following the portfolio. So just something to think about. But mathematically, the answer could be somewhere in that 16 plus or minus 4 range.
I think another point, Mark, just for us being new, is we've been spending a little more time probably than a more experienced club would do just learning how to do some of this. So we've been trying to keep our money invested, but we haven't been as focused on trying to accumulate too many stocks too fast.
Mm-hmm. And again, it's a long-term thing. You don't have to hurry. It's just a kind of a very prudent march. Well, how much is too much when it comes to the percent of portfolio? I mean, I've been in clubs where one of the positions in the portfolio, for all the right reasons, all the wonderful reasons, might have gotten up to 30 or 35% of the portfolio. That's a bit much. And the flip side of the question is, well, how low or how little is too little? And this is just kind of a guideline. Again, for a portfolio that's in that 12 to 20 range, we just picked 16. All that is just a mathematical breakdown on, how big might you put for a limit on the largest position size. Again, somewhere in that 13, 14% range, and the smallest position in the portfolio ought to be somewhere down around the 2% range. If you've got a bunch of 0.2% in the portfolio, they're really not ever going to do much for you. Very unlikely, anyhow. So again, somewhere in that range of, I don't know, 2 to 14%. For a 16 stock portfolio. And again, with Northern Traders, they're down at this end still. So, you may have noticed that some of their portfolio positions were in the 20s. Absolutely nothing wrong with that. I mean, look at this point right here, 25% right here. Nothing wrong with that. But as the portfolio grows and they add more stocks, they will want to kind of naturally want to drift down into these type of positions. So again, just just kind of a recommendation guideline for position size.